right, Amar, we're here, and I think that we're also live. I just need to let the other people in the meeting really fast.
Sure.
They come trickling in. So we usually start about 2 to 3 minutes later. But while I have you here, you're from Florida, right?
Correct.
Johannesburg?
No, St. Petersburg.
St. Petersburg. I don't know why I thought Johannesburg. That's South Africa, not Russia. Anyway, I mean Florida of all places, right?
Yeah, so close to Tampa.
Very good. And you're a physician?
I am.
General physician, or do you have a specialty?
Yeah, so I'm family medicine, so I do hospitalist medicine though.
Okay. Very good. Family medicine, but hospice medicine as well. So a little bit more of elderly care.
Hospital.
Sorry.
Yeah. Sorry.
I'll turn my sound.
There is a lot of end of life though. Yes, in Florida we do have a lot of older population. So either way.
Well, very good. Well, we have you from Florida. We have Eddie from London. Eddie, how are we doing today? Okay. Turn the mute on. There we go. It looks like he's on a call real fast. We'll let him take that.
What really matters is
we have Venatus, who was actually talking to Eddie. How about that? Fun.
Hey, Jay.
Hey, guys. Thanks for joining again. We'll go ahead and get started a little bit.
Hello.
Eddie, how are you?
I'm not too bad. I brought one of my own in the meeting.
Venatus, how are you? Oh, you're on mute. Where are you at today, Venatus? What part of the world?
Oh, hi. Yeah, doing well. I'm in the UK at the moment.
Okay, very nice.
One of my UK brothers.
We've got Alejandro, and we've got Micah, and we've got Mafe. We have Amar as well. Amar from Florida. So everybody say hi to Amar.
Hi.
All right. So today we're going to discuss what do high-income earners do to help offset some of that taxable income that they otherwise are not able to through their businesses, or if they are a high W-2 income earner, what are their options? And a lot of times people think of a few different things. They think of charitable giving. They think of oil and gas or other types of mineral strategies, or they think of this particular mineral strategy we're going to talk about in detail today, which is similar to the arts and antiquities. Arts and antiquities fair market value deduction that you're able to get. Now, how does that all work? Amar, if you have a famous painting, if you have the Mona Lisa in your house, and you've decided that you don't want it in your house anymore, that you want to be charitable, you want to donate it to a museum, that you're not retaining rights to it, you're actually giving it up to the museum, and you want a deduction to offset your current income because you make a lot of money, and you know the Mona Lisa is worth a lot of money. So let's say that it's $20 million or whatever it might be. I'm terrible when it comes to arts antiquities and what the real value is. I have no idea. But let's say it's $20 million. It may not have cost your great-great-grandparents or whoever had it to begin with. It may not have cost them that. In fact, it might have been a gift. Their basis might be zero. But you're able to write off $20 million for donating it to a museum. There is a strategy out there with minerals that is similar to that type of arts and antiquities deduction strategy. It's similar, but it's different in a few different ways, and we're going to discuss that right now. Again, I always try to give a high-level overview of what the strategy is. Then we talk a little bit about who we are and what our vision is and what we're trying to help people do. And then we answer questions that people might have about the various strategies, or we can touch on other topics as well, such as oil and gas. But essentially, there's a number of different products or minerals out there that are beneficial if processed and refined into other things. And one of them last year that was very popular was magnesium. Magnesium, which was mined, individuals were able to participate in it. They were able to have an LLC that had some ownership of so much crude magnesium, crude or raw magnesium from the ground. That raw magnesium would get an increased fair market value after it was processed and refined into supplements. Those supplements would then be donated by your LLC, would be donated to a charity, not just any charity. You can't choose or have authority over which charity it goes to. We had a good working relationship with the Stroke Foundation, which is a national charity. And the Stroke Foundation would take these magnesium supplements and they would distribute them out to other individuals that have suffered from strokes to help prevent the next one. Now, Amar, you being a family physician, you can probably speak to that more than anybody else here in the room. Are you familiar with, I mean, can you maybe shed some light on what magnesium does for stroke victims?
Yeah, so magnesium helps with the vasculature as well, in addition to helping with free radicals. It can help with providing energy. It helps with with hardened vessels, increasing blood flow, and also a little bit of vasodilation as well.
So people last year who put money into the actual extraction of magnesium from the ground, they would put in X. Let's say they put in $100,000. And they, at the end of the day, because the magnesium that's extracted from the ground would then be processed and refined and then turned into a supplement and then donated. I forgot a very important step. It would receive an appraisal. Once it's in its finished product, it would receive an appraisal. Then it would be donated, just kind of like the Mona Lisa, before giving it to the museum. It would be appraised by a third-party, unrelated, group that specializes in appraisals of that type of a thing, right? It receives an appraisal and then it's donated to the Stroke Foundation. That appraisal oftentimes would come in 4, 5, 6 times greater than their initial cost to extract it from the ground. And this is a tax strategy because individuals are able to participate in existing LLCs that have been around longer than a year, so the holding period is there. Because there are some rules. You can't just take a Mona Lisa and buy it for $10 and then sell it for $100 2 days later and get the $100 deduction, because you have to hold it for a period of time. Same with this strategy. So these LLCs have existed from before. Individuals buy into them with their contribution. That contribution then becomes something greater because you get the fair market value of what it is appraised at when donated as a non-cash charitable contribution to the charity. This year, we don't have an agriculturalist in the room rather than a physician. Thank you, Omar, for your insight there. This year, because all of the magnesium in this mountain has been extracted, we're using volcanic ash. Volcanic ash has a lot of mineral content as well as other features inside of it that help retain water and help roots actually pull other nutrients out of the soil that are there that they otherwise wouldn't be able to absorb. And the volcanic ash that is actually mined here in Utah is being sent to the country of Haiti. Country of Haiti, where literally if there's bad weather and the ships can't come in, they don't get produce and they don't have food. And their diet, they're malnourished, everything else. So this is a humanitarian and this is a charitable effort to help them become a little bit more self-reliant, grow a lot of their own fruits and vegetables and things of that nature. And there is a increased value in what is mined in volcanic ash from the dirt, processed and refined into soil conditioner, and then donated to this foundation in the country of Haiti to help farmers and help everybody else become, again, successful at becoming independent and growing some of their own fruits and vegetables. And to also start up industry in the farming industry in the country. The benefit to the investors is the same, whether it's art, whether it's magnesium, whether it's volcanic ash. Participate by buying ownership in these LLCs that have existed for longer than a year, and the LLCs own so much of the raw mineral of this volcanic ash. This volcanic ash has a process, has a refinement, becomes a retail value good that then has an appraisal. And again, historically, 3, 4, 5, I say historically, it's never been 3. But we like to say 3, just in case it ever happens to only be 3. But usually 4, 5, 6 or more times multiple in fair market value deduction is what people are able to receive. Why do people do this other than the fact that they're charitably inclined to do this? If we live in the state of Florida and we're in the highest tax bracket, which is 37% federally, if we make $100,000, we'd normally pay $37,000 in taxes. If we donate $100,000 to this process, we might get a write-off of, let's say, $400. So if we decrease taxes paid on $400 when it only cost us $100, if I take 37% of $400, what is that number? So we're going to do 400,000 times 27. I receive a tax savings of $147 at the 37% tax rate. So essentially, I've decided to pay and give to charity, which is the incentive. This is the motivation that the government allows for us to get a benefit for giving to charity. We don't have to give as much to government. In this particular strategy, there's an arbitrage or a delta where we come out farther ahead than normal or than other people. And the way we're able to do that is, hey, I put in $100,000 into this LLC, but this was kind of like a working, operating LLC that had a process. It extracted minerals from the ground, donated to a qualifying charity. There are other rules involved, like you can't choose the charity, all this other stuff, everything else. But like, hey, it went there, and now I have an offset of the fair market value, which could be 4 times greater. I got an offset of $400,000, which saves me $148,000 in taxes. I put in 100, and I saved 148. The delta is 48. So from a tax perspective, it's kind of like a no-brainer. Would you rather give 100 to the government, 148 to the government, or just 100 to the charity? And then be able to save the 48 because you did so. So that's kind of the reason and the purpose. And again, every appraisal sometimes comes in a little bit different. We had several people that came in near four times last year. We had a couple individuals that came in more, and they had excess. What does that mean, excess? There is a limitation of 30% of adjusted gross income. So if your adjusted gross income that you're going to be taxed on is $1 million, and you put in 100 and got a 4 times multiple on the fair market value, the appraised value, if the appraised value came in at 400 and you got that as a deduction, in the current year, you are limited on a non-cash charitable contribution of 30% of your AGI. If your AGI is $1 million and you got a $400,000 offset, you're only able to offset 300 of the 400 this year. What happens to the extra? Well, you don't lose it. It just rolls over to the following year. You can roll it forward up to 5 years on a non-cash charitable contribution. So very good. You knew the answer already. You've been doing your homework. You're probably a charitable person already. By the way, this falls into a different category from cash contributions. So non-charitable contributions, cash contributions, different categories.
Okay.
And again, it sounds strange because you're putting money into the LLC, right? So you're thinking it's a cash contribution, but it's not, because it's actually the raw minerals that you end up owning in the LLC. And you're not going to get a different appraised value on cash, but you will get a different appraised value on the improvements done on minerals. Kind of like, over a period of time, art might appraise for more if it's more sought after, if it's still in good condition and everything else. But they have to make sure it's still in good condition. If it's art that is damaged, it might be valued at something less. The same thing with these minerals. If we have a faulty batch of magnesium supplements, well, shoot, you were in the business of extracting minerals from the ground and turning them into supplements, and you had a bad go. So they might not appraise for what others appraise for, which is why it's important that they're always appraised. Unfortunately, that never actually happened to us. But there is risk in this, which also allows for the deduction.
Okay.
Yeah. And there's another one out there where we do medical kits and we send them to Africa and other things like that too. But these are some of the strategies that we help high income earners with. where they get a delta, there's an arbitrage, they end up with more than they would have otherwise if they just paid the taxes. And again, the government allows us these motivations to put money into charities that are doing a good thing and to give us this extra benefit for doing it on a tax standpoint. And our job is just to help in this mastermind. That's why we're all here today. Is by the way, there's 7 of us here on the Zoom. There's several more on LinkedIn and Facebook and other places. Unfortunately, I can't pay attention to all those comments all the time. So if people want to participate, they have to enter into the Zoom link and grace us with your presence. Turn on your camera, ask questions, participate. I think that a lot of the questions that everybody asks here helps a lot of people that also have the same questions, but they're perhaps not willing to come on screen, if that makes sense. So feel free to ask any and all questions about this strategy or other strategies that you've heard of. You have no idea how many times I get questions from people, other professionals, CPAs, attorneys, financial advisors who ask me, hey, my client went to this dinner seminar with this attorney and they learned this. And what's the reality of it all? And sometimes I know the answer immediately, sometimes I don't. I did have the good fortune of being an instructor, a coach, a mentor, as well as a back office support for a very large association of CPA firm owners from across the country. And so I was forced to learn about a lot of strategies that exist there from all over the world. And I like to tell people that I'm just a normal, ordinary guy that had a quite extraordinary experience. And because of that, I know a lot of stuff. Doesn't mean I know everything, but I know a lot of stuff. I can oftentimes answer a lot of your questions. So more than happy to help and entertain or do some research and come back on anything that you might be able to present that maybe I don't know about. With that being said, are there any questions right now from the group?
Yeah, Jake, I've got a question for you. This is not coming from me, it's coming from one of my connections that lives in Dubai, and he's a high tax earner. One of the things he's trying to do is actually buy a private jet charter service, which will cost him $650K a year. And he wants to see if that would be tax deductible because he'll mainly be using that for business travel.
Yes. That one's easier than some of the others that I get. And I'll say that under most circumstances, yes, but the proper documentation has to be in place. He has to prove that it is for business travel and that it's not just luxury.
How do you prove that?
Documentation, and he also needs to charter it out to other people at least once a year. Now, let me put together an example that we did recently on an individual that was suffering incredibly high. When I'm talking high, I'm talking $5 billion high capital gains. This individual had a team of 6 people, and I was the 7th person that got added to the team on putting together strategies to help offset that very large capital gains. Everything from buying a $156 million yacht was included. Now, how does he write off a $156 million yacht? Now, these strategies all pertain to everybody else here in the room too. Just take away a few zeros. All right. Instead of a $156 million yacht, it could be just, a small yacht that's like whatever, 400,000. But he had to at least charter it out to somebody else besides himself at least once a year, every year, to maintain its business purpose and business use, in addition to him doing business on his yacht. So when he was out on his yacht doing maintenance and repairs and making sure that everything was in good order, I'm giving you hints here as to the documentation that you need, as well as while on the yacht, having Zoom, having internet, having the ability to communicate, to manage his businesses remotely, and essentially have it be a remote office, a remote business location, as well as the fact that he actually leased it out or rented it out to somebody else no less than 1 time a year. Now, a plane, is that what we were discussing first? Yeah, a plane is a little bit easier. It's a little bit more commonplace for executives to have a plane. Now, depending on the size of the plane, it may be some of the documentation functions or if its use might need to be different.
Okay, I know I mean, I don't know exactly the plane size, but I know it sits 8 people, is what he said. Regarding, I guess, leasing out to someone else one time a year, would he be able to do that with one of the board members that he has on the team?
Absolutely. In fact,
Okay.
I have a business partner right now. He's from Kansas. And he just went on a private jet. And guess what? It seated 8. He just went on a private jet and went to the Bahamas to an island, a private island that somebody owns, to have some business meetings. Not to sound fancy or anything, but that's what people do when they have way too much money. And they need the write-offs. Every bit of that plane and the service, the catering on the plane, everything else is for business purpose, business function, and is a write-off. Now, of course, write-offs like that get disallowed if 2-3 years later you're not able to provide support and evidence of the trips and the travel logs of the people on there. A plane, it's a little bit easier because you have travel logs that you have to keep regardless of who's on the plane, what they had in their possession when they left, and what they had in their possession when they arrived. A lot of that's required because of like smuggling laws and things like that. But that helps for the accounting documentation necessary if you were ever to be audited and you had to prove an actual deduction of that plane and that you weren't just doing personal trips all the time.
Okay, thank you, Jay.
Yeah, no, thank you. There are similar logs for deep water vessels. Like a yacht that's 156 million is considered a deep water vessel. But smaller yachts, it's a little bit more lax. But for the same reasons for the accounting, you have to be a little bit more stringent on their logging so that it's not, they can't come back to you and say, hey, you only ever use this personally and we're going to take away your deductions. Because they say you can do anything at least once until they catch you, right? And then once they catch you, you got to prove that you did it the right way. So it's better just to prove it as you go, expecting someone to take a look at it. You know, I mean, the IRS is kind of revamping their entire personnel at this moment as we speak. And though they might be incredibly disorganized for the next year or two, after that, we're going to see an IRS team that is, one, younger, more tech savvy, and a lot more able to do their job correctly. Right now, most of them are still, half of them are still working from home. I mean, the rest of us have returned to our normal everyday lives after the pandemic, except for the IRS. Half of them are still working from home, and they, have you ever gotten an email from the IRS? Like, any correspondence is always faxed. And where are the fax machines? They're not at their home. They don't have a digital fax like a lot of business owners do for compliance reasons. Anyway, I'm just talking about government. But eventually, government's going to catch up. Amar, I know that you have maybe just another 10 minutes or so with us. Do you have any questions that we can entertain at this moment?
I mean, I think, I mean, I'm still trying to learn a lot of this stuff. I mean, it sounds, so with regards to rental properties, for example, like I have some rental properties, a couple of Airbnbs, and then one is a duplex. And, you know, we've been doing the Augusta rule every year. What are things that I can do to make sure that my, you know, bookkeeping part is tidy with regards to that, to what the IRS wants?
Very good. So Leah and her team can work with you. They might charge a little extra to provide you with all this documentation, or I can tell you exactly what you need and you can take care of it yourself, right?
Sure.
Nobody's going to be offended for me telling you what to have, because we're all very clear and transparent about what's needed. It's just whether you want to do it or you want someone else to do it, right?
Right.
So there's a number of different ways to benefit from the Augusta rule. One of the most common ways is to have board of director meetings in your home. Have board of director meetings in your home where literally you're facing this way and you say, hey, finances this year look like this. And you can say, hey, you know, that's okay. I think we're doing okay. we're doing good, but we should allocate some more money to the accountant because we love the accountant. And then, hey, we should look at these investments. Like you literally have a board of directors meeting of one if that's what you have. I say that a little bit in jest. The important thing is that it's on paper. So you have a board of directors meeting minutes. So just notes with some kind of an agenda. And the thing that you're doing here is you need to justify a proper business use so that your business can spend money on the location, which happens to be your home, that it's a justifiable business expense. And you can't take it more than 14 times a year, you know that. But how do you document things correctly? These documents you will never, ever, ever need unless you get audited. Should you get audited, you hand it over and you say, hey, this is what I did. I really did have a meeting 14 times a year. And in that meeting, I discussed finances. I talked about investments. I talked about my taxes. You know, one of them, I had a Zoom meeting with my accountant, with the board of directors, which was me. The other one, I had a Zoom meeting with my financial advisor. The other one, I had a Zoom meeting with whoever. And the others, I didn't have Zoom meetings because it had to do with internal stuff. I had to review the finances. I had to review expenses. I had to look at places to trim down because revenue wasn't as good or revenue was greater. So all these decisions that we make subconsciously or just every single day, you should just summarize them once a month.
Okay.
Summarize them once a month. That's 12 meetings, and then do like 2 semi-annual meetings for other topics. Or have a client appreciation day at your house. So that's different than board of director meetings. Have a client annual medical update meeting where you give free advice and you present for 15-20 minutes to a group of people over cocktails or over dinner or over whatever, right? Just whatever is good for you already that might be a proper use of your home, that the business gets a benefit from and is justifiable, then we can count that day. We just have to document like a attendee role and a summary of what was presented.
Okay.
So if you were your own secretary taking notes of important financial events, that would be all that you need to do in a very high level general way. However, a lot of times for clients, somebody like Tina or Leah or some of these other accountants might provide you with an outline, a template, just to make your life easier. But they're still going to look to you for the content of that template.
Well, and some days might be better to rent out your house than others because of just the market in your area.
Now we're getting strategic about the cost. And Tina's laughing because she does this in the sense that if comparable venues in your area, like the next conference room nearest you in the most expensive location possible because you want it to be posh, is expensive already on any normal day, but even more expensive or exclusive or VIP on Christmas Eve, on Valentine's Day, on Labor Day, on any of these highly sought after days to rent out a venue, that's when you should rent out to yourself. Because your comparables will be much more expensive. Sometimes they're difficult to get because a lot of times you call them up and say, hey, we're booked out for 3 years on this date. You can't, we're not going to send you a bid. Well, please send me a bid anyway. I need it. Because you need it as evidence of why you charge yourself that rate. Sometimes that work is painstaking. And sometimes accountants in your area, they've already done some of that work and they might have it all ready to go. So it might be easier that way. Or it might be good for you to know and just educate yourself on how the strategy actually works and how you justify support for the money that your business paid you that then gets filed on Schedule E as rental income, but there's Form 280A that means that it's rental income that is exempt, which is what you want. And it's fun. I mean, sorry. If you're a finance guy, an attorney, a consultant, or an accountant, making numbers work for you is fun. Where you just help people feel better, I'm not sure that you love the numbers the way we do.
I like numbers too.
Okay. Well, very good.
Thank you.
Well, I know you got another meeting if you do have to jet or if you have any other questions. Do you have my calendar link or did Leah schedule your time with me?
Actually, I do have your Calendly link, I believe. If you could resend that to me just in case.
In fact, Micah here on the call, she'll send that over to you right now in an email so that you have it. We can schedule another
Okay.
time to go over some of the oil and gas options. We can discuss more on the mineral options. We can do a few other things just to make sure that you're doing year-end planning.
Yeah.
That makes sense. And
All
of
right,
course,
perfect. Thank you.
as soon as you jump off the call, you're going to remember all those questions you didn't ask. So you have another opportunity to go over them.
Okay. I appreciate that.
Thank you. Have a
All
good
right.
day.
Nice to meet you.
All right. So everybody else here in the room, we gave a little extra special attention to Amar because he had to jump into another meeting, and he literally is a physician that was just on his lunch break. Nice guy. Any questions about the Augusta rule or the Augusta strategy? Any questions about the mineral strategy specifically? Because the mineral strategy is really what we're up against the wall with as far as deadlines this year for people who want to participate in it. They need to kind of get in fast because volcanic ash, there's only a limited supply and it might run out. Venatus, where in the UK are you at right now?
Essex.
Essex. Okay. I've never been to Essex.
Yeah, I'm grew up Greater London, but I've moved to Essex. Recently got a mortgage with my fiance.
Very nice. That's definitely a step in life, right? To noteworthy
That's it,
step.
yeah.
Very good.
I just wanted to ask, is this, so you're saying there's a time frame on the mineral ash? Is that specifically to mineral ash this year, or is it the whole scheme this year?
Just in regards to the volcanic ash mineral strategy this year, they say that they accept contributions up until the last 2 weeks of the year. However, if they run out of the mineral before then obviously they can't accept any more after they run out. It's become a very popular strategy, so a lot of people are participating.
So essentially, if you've got a company, you can then acquire another company that already has been holding minerals, and then you can donate them, and then can you use that to write off on your main company?
You can, however, this is a strategy that sometimes works better personally. So instead of through another company and then into the LLC, individuals here in the United States will buy into it directly because their non-cash charitable contribution limit personally is at 30%. Whereas if it's like through a C Corp, their limit's not 30, their limit's only 10. Now, granted, a C Corp revenue might be much higher. So 10% from a C Corp might be more dollars than 30% from an individual. And so we have to weigh the pros and cons. Does it make more sense for a company to buy in or for a person individually to buy in? There's a lot of pass-through entities here in the United States, the S Corp, a partnership, or just a single member LLC, that it all flows into the person anyway. So it makes more sense to buy into this LLC and contribute into the mineral strategy personally rather than through an entity, unless, of course, they are a C Corp. And so now, of course, if you own a U.S. business and you're trying to offset U.S. income, and it's an LLC or something like that, then we might need to do some more advanced tax planning so that your U.S. taxes can be decreased by the same strategy. Which we do that, when I say do that, we help foreign individuals who have a U.S. presence quite often, where the rest of the world is incurring a lot of inflation, where the rest of the world, we're incurring inflation, but we think that we have it bad until we see what other people have. The euro right now is the lowest it's been in a number of years. And so just to point out a few different things, there's a lot of attention that the U.S. is getting from an investment standpoint from other countries, citizens of other countries. We talked to the M&A coach advisor, Sebastian Amieva, right? And we talked to him about where are the deals, where are the deal flows in the entire world, because he's a global traveler, right? And he says, hey, by and far, we've got Canada and the United States. Canada, United States, and Dubai. Very much the 3 locations of the world where the most deals are happening, the most mergers and acquisitions. And so that's still exciting to know that even though in our country we're seeing a gallon of milk go up to insane prices, gallon of gas going up to insane prices, we take a look at the rest of the world and it's not so insane. But it's just not as bad.
To add on top of that, I am becoming more and more interested in Dubai because Dubai real estate, Dubai oil deals out there, they're increasing in prices monthly. From what I can see from the research that I've done by 2023 or next year, really, the housing prices should be increasing by at least 80%. So it's a massive, massive jump, and it's only because Dubai is becoming like this global hub of investment, the future of the city, as they like to call themselves, which I think is going the right way.
In Dubai, they have a lot of tax incentives, which
Yeah.
if you look at the per capita percentage of people who live in Dubai that are actually from Dubai, like they were born there, 95% of the people living there are not born there. So Dubai has become a mecca, or has become an attractive place tax-wise and through a number of other incentives. Not just tax-wise, they'll actually provide you funding very easily compared to other areas if you've got something revolutionary. If you have something revolutionary in healthcare, in technology, or something that is leading in the world, or disruptive innovation, something like that, they will do everything they possibly can to get you to headquarter in Dubai. And so it is one of the most diverse culturally places in the world, because you have people from all over the world moving there. Now,
from your experience, Jake, what do you think about Dubai? Would you ever invest into that area?
The answer is yes, but with hesitation. I say yes with hesitation because they are so good at bringing the best of everything to Dubai. They're also very good at making it theirs. So unless you're willing to move there and live there, it's very likely that you will get cut out or lose some of the actual benefits of receiving funding or receiving tax benefits and perks there. So what makes them so good also makes them, should give you caution of the loss of control, as well as the, you're going to uproot your entire life to make it happen. And if that's not an issue or a problem, then just realize you have to be all in and you have to be there with them. It can be a wonderful place to mix and mingle and put down new roots and things of that nature, though obviously it's very different from a lot of other places in the world. And sometimes, you know, like during the pandemic, as a great example, some of the rules imposed are a lot more stringent than they ever were in Utah, or they ever were in Texas here in the United States. But I say Utah and Texas, I'm dividing the United States into the 50 states and the 7 territories, right? Because California might have been very similar to Dubai in restrictions. But I never once in all of the pandemic did not come to my office. I was never once forced to not. So I live in the land of the free, at least my little piece of the country, even though the rest of the country is not the same. That's a little bit of a political humor for you. In regards to oil and gas, I mean, there's a lot of things we could talk about today, though I think because we're running up against the end of our time, willing to entertain one more question, or we just talk about how people can schedule, how they can meet, how they can get a one-on-one so that we can answer more specifically their scenario, how these strategies may or may not be applicable to them, how they may or may not be eligible, and if it makes mathematical tax sense from not only a cash flow, but a tax flow standpoint. So if anybody has any final questions or comments, Venatas?
I had a really vague but hard to answer question. So say you, you've been earning money in America, for example, and now you're a tax resident in Dubai. Say you have something you can write off that you initially invested in America. Can you write that off even though you're earning in Dubai?
So there's something that's called Nexus. So let's say that you bought rental property here in the United States, or a business, like an excavating business. You have some kind of asset here in the United States, and now you live in Dubai. The United States is one of the only countries in the world that will take your entire global income into respect or into consideration based on what they're going to tax you. And they make it the big number, the biggest number possible. And if you qualify, because you're paying taxes somewhere else, so Dubai, there's no taxes. So that doesn't help you from a US tax standpoint. But let's say that you established residency here and then moved to Dubai. So residency and income producing assets, you are absolutely going to continue to get taxed while you maintain assets here in the United States after you leave. Now, let's say that you never established residency. Well, you're only going to be taxed on your US income and assets as long as you did not live here for 90% of the year. So if 90% of the year you did not live here, but you have US holdings, then under that scenario, you'll only be taxed on the income from those US holdings in the US, because you're not considered a US resident, nor did you, this sounds strange, pass the time test. Passing the time test is actually not in your favor. That means that you would owe more taxes on your global income, even though you made it somewhere else. So you got to be careful how long you're physically, the physical presence test, how long you're physically in the United States if you own US properties and assets. Now, there are ways of doing things a little bit differently, because you can do these IBCs, these international business corporations, like the Bahamas or the Seychelles Islands or Caymans or wherever, right? And those can hold US assets. Those US assets have to report tax returns and filings. But there are ways of getting the money into the IBCs to where you minimize greatly the US presence. And as long as the money is not brought back into the US, or what a lot of US people do is they have these IBCs own offshore assets, and as long as the money is never brought into the US, oftentimes it is not considered for tax considerations. There's a lot of particular items that need to be discussed there from a compliance standpoint, whether or not you're eligible to do things or not, or what you don't want to do is ever appear to be evading the US government when it comes to taxes. So there's a right way and a wrong way to do things. Tina's asking on the volcanic ash real quick. This is the last question, everybody. Do we know what the fair market value will be for sure? Well, we never know until there's an appraisal. And so I sometimes we use the number 3 times, 4 times, 5 times, 6 times, whatever the multiple might be. We don't know for sure until there's an appraisal. So the process is we have clients put money into an LLC, so they buy shares in this LLC that owns the raw mineral. They then, so this LLC has passed the holding period. It's been around for longer than a year. So the volcanic ash that is owned by this LLC is then refined and processed and turned into soil conditioner into something of a higher value. Before being shipped and donated to this charitable organization in Haiti, there is an appraisal. And that appraisal will dictate what the new value is. It doesn't actually dictate a multiple. We sometimes talk about it in multiples, but it just gives a fair market value that coincidentally, oftentimes, is 4 or greater times multiple. So for calculation purposes on understanding or predicting or estimating, maybe is the best word, what a future deduction will be on a 30%, subject to a 30% limitation of AGI. But if we are to provide a client with a rough estimate subject to an appraisal, I feel safe about using a 4 times multiple for that purpose. Understanding that when the appraisal actually happens, it may come in less, it may come in greater. But that is our understanding so far, is through what has already been processed and refined and shipped, that it'll be, you know, if we put in $100,000, oftentimes it'll appraise for over $400,000. But there is no official formula of what it will be. It'll all based on the appraisal. And that's the proper compliance language. Okay, everybody. If you would like to know more or schedule an appointment with Micah, Micah is the person that takes orders for this strategy. When I say that she takes orders, she helps you fill out the online application. Make sure that you don't forget to check the box, because you have to place a vote to actually donate your minerals. And if you forget to check the box and you don't actually donate, you don't actually get the deduction. And we would hate for that to happen. So to make sure that you cross your T's and dot your I's, give Micah a call, schedule. The phone number is 1-800-773-1848. Micah has put her email in the chat, as well as you can look at our website and book an appointment. If you'd like to know more, if your situation is a little different, especially if you want to donate through a business, let's weigh the pros and cons. Let's run some numbers. And you can schedule an appointment on strategictaxsolutions.com. That website, again, is strategictaxsolutions.com. There's a little registration box for you to join the mastermind meetings and be reminded every week of those masterminds, as well as if you exit out of that registration box, there's a booking link where you can book an appointment. Or if you know what you want already, just give Micah a call. She'll answer the phone. Thank you so much. Hope everybody has a great day. Bye-bye.